Welcome to this week's edition of Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the S&P 500. I'm going to cover the ASX 200 as well as gold, copper, uranium in a separate video. I'll leave a link for that in the description section below. As always, this is general commentary, doesn't take your personal situation into account. And I've also got something else which is really interesting for you today. It's a key market which is at a level which you've just got to see. So make sure you stick around for that. Okay, with all that said, let's get into our first chart. So I've got the S&P 500 up on the screen, and it's been a really big week, really important week, I think, for the S&P. We've got that bounce. We got the bounce that we were talking about last week, and it's taken the market back up to the moving averages, which is around the level that we're discussing was a possibility for a rebound to target. It's encouraging that this bounce so far has been, it's encouraging that it's been strong, that it's been a robust rebound. And it's coming off two key layers of support. So firstly, we've got the support from this upward trend channel. Now the upward trend channel has been in place since the September low. And actually, what was it? The October low. That's where the trend channel began its journey upwards. And more important, though, I think it's this structural support that comes in at around 4,200. This was a key resistance area on the way up, and I expect it's going to be like a battleground support for now. Whether it's holding the market up or if it breaks, I think it's going to be a considerable event. Now, what I like about the strong bounce is, going back to last week, I said my key concern was a shallow bounce. So this is a bounce that doesn't get too far, doesn't retake the moving averages, just trundles sideways for a week or two. And then when you get a bounce like that can't really lift itself off the floor, that's when the potential opens for a break of support and a test of lower levels. That hasn't happened. At least at this stage, we've got a good bounce, and that keeps, I think that keeps the bullish scenarios in play. At this stage, I think that the move lower from this July high, I think it fits the parameters for a pullback. As I say, I think this structural support at 4,200 is key. Below there, then I think the pattern flips. Break 4,200, the pattern flips, and that's when we start to really have to start consider some of those more bearish possibilities that like certainly do exist, but at the moment I don't think we need to go there because that's not it's not the current setup. We're dealing with a bounce of support, so we want to see where this can potentially go. And the other thing to remember is just jumping to a weekly chart. Just looking at this 50-week moving average, we've got the market bouncing off the 50-week. And as I've shown you in previous videos, you often find periods where the market comes back to the 50-day and bounces. So we're going to see what happens on this occasion. Is it going to be a bounce, or is it going to be a fail at the 50-week moving average? Now, something else I want to show you. Now, I showed you this last week. This is this lower indicator is showing us a number of S&P 500 stocks above their 50-day moving average, and above there we have the S&P 500. So I was telling you about a situation last week where the number of stocks above their 50-day moving average had hit just 5%. So it's a level which is infrequently seen. It does come up every few years, but it's not that much of a frequent event. And so the point of that all was to say that accelerated declines typically don't occur when the number of stocks below their 50-day moving average gets to that low point. I'm looking at it from a different perspective today, because what we've seen through the week, we've seen the number of stocks above the 50-day moving average rebound strongly and now move above 20%. The point I want to make today is when we look at what's happened on previous occasions where the indicators bottomed out and rallied, let's see what's happened. So I've marked them with the blue lines you can see on the chart. The trigger point is touching 5% and then breaking back above 20%. So these blue lines mark the previous times when that has occurred. And you can see they all coincide with significant low points. Now you can take this indicator back further. This is typically the way this tends to play. What's going to happen here? You can just zooming in a little bit more, just so you can probably see these a little bit clearer. You can see touch 5%, retake 20. It's an important low moving forward. Touch 5%, retake 20, important low. This one here, you can see touched 5%, retook 20, and it didn't play out. So no indicator plays out every time. That was during the COVID crash. But on the whole, it's got a pretty good record of touching 5, breaking 20, and it being some sort of a turning point. So we're going to see how this plays out on this occasion. I think it's something important to keep an eye on. Now, I think just jumping back to our S&P 500, I think that cautiously long remains the play. I'm mindful that the S&P 500 is below these moving averages, which have started to turn and starting to decline. As I said last week, I'm selling stocks in my portfolio that are breaking support and that are hitting their stops. But I think on balance, just looking at what we just saw with the number of stocks below their 50-day moving average, looking at where support currently is, I think on balance, it's a case of treating this as a pullback, not a major reversal. But let's just see how the price action plays over the next week. Now, if you're getting value, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. It just lets YouTube know you're watching and you're engaging, and YouTube does its magic and shows other people, which helps me heaps. So please do that for me. And now let's just jump over to a few other markets. Let's have a look at the Russell 2000. So the small caps. And look, this is the weak link, and this has been the weak link for some time. The small caps. Thursday's price action was disappointing. Of course, I don't have Friday's price action because I'm recording this on Friday afternoon in Sydney. So the US markets are yet to open for Friday. But what we've had for Thursday, it's just disappointing. Good, encouraging rally early in the week, and then it's given it pretty much it all back on Thursday. Retesting the support around 7,010. Sorry, not 7,000, 1,710. Retesting that support zone. It does seem oversold. When I pull up RSIs and I look at this, it does look like it's at oversold levels. But I think risk remains high while the price is below declining moving averages. They crossed back in late September. They're in decline. The 50's below the 100. Markets are always vulnerable. They're just vulnerable below, oversold, but nonetheless, got to respect when something's below the moving averages. That's when things can come apart. Having said that, look, I've been hopeful for a while that this could turn into some sort of a large basing structure. Hasn't done so as yet. There's no immediate sign, at least anyway, that this has become a large basing structure. But what has been interesting is just through the week, I've been seeing articles talking about the possibility of this whole move in equities turning into another 1987 style crash. And the last one of these I saw was it was on Thursday, and this often occurs in October, because October is known as the crash month, because that's when some of the biggest crashes have happened. They're incredibly rare, but they have happened in October. So often happens in October that we see these sort of articles, especially when the markets are coming off. We see these articles of, is this going to turn into another 1987 crash, particularly with interest rates going up. But I think the likelihood of this turning into some sort of big event is, I think it's really unlikely. And I just want to show you, take the NASDAQ, for instance. So this is the NASDAQ over the last year, looking at the price action, big run up. We've had a pullback like we have in the S&P 500 and other global indices. But just look at the pattern I've drawn. At the moment, this is shaping up as a bullish flagging formation. So the pullback looks entirely corrective. It doesn't look like it's setting up for a crash by any stretch. If anything, it looks like it's setting up for a break to a new high. So this is the great uncertainty we have in the current market. And I think it's why extra caution is necessary. It doesn't look like it's set up to crash, but we have a situation where the small caps are really stuck in the mud. They're not going up whatsoever. And we know that healthy bull markets have broad-based participation. But this is so mixed. We've got the NASDAQ looking constructive, the S&P 500 is somewhere in between, and the Russell looks ordinary. So it's there's a big disparity between the indices. And this is why I think the play remains being cautiously long, not being scared away by stories of October disasters, but being cautiously long until the price action tells us that we should be doing something else, and also knowing where your exits are. And one quick last thing, just keep an eye on this US 10-year bond yield. It's hit this resistance point up near 5% just in the last week. It started to pull back from that, back towards the moving averages. Let me quickly show you why 5% is such a big deal. I'm putting this onto a weekly chart, the bond yield, 10-year bond yield. And you can see this has been a technically active region going back to, on this chart at least, going back to the early 1990s. And here we are, we're touching it again. I think the possibility of some sort of a large pullback at some point is coming. I'm not going to predict that by any stretch because the trend is still up, but I'm aware around 5%. And if we do get some sort of a notable peak, some sort of pullback, it's going to have implications for equities, probably a positive for equities. We don't know. These things haven't happened. It's something to keep an eye on, something to be mindful of. So look, let's call that a wrap for this week. Thank you for joining me. It's been great talking to you again, and hope that was interesting. Look forward to coming back, doing it again next week. Till then, bye for now.